Welcome back to Accrued Interest. Today, March 26, 2025, I'm going to talk about how you can tell if the market thinks a stock is undervalued or overvalued. But first, a brief disclaimer. Everything said on this podcast is for educational purposes, as I am not a registered investment advisor. All of us would love nothing else to know exactly what's going to happen in the future so we can get in the time machine and know what stocks to buy or sell. I'm always going to keep it real with you. There is no investment methodology that is guaranteed to make you profits. I'm going to show you how, using publicly available information, you can use some techniques that Wall Street analysts use to value stocks so you can increase your investment success. First, valuation should be based on free cash flow, or whatever is the closest proxy to free cash flow. Sales is not a good valuation metric because it completely ignores the profitability of a company. Secondly, valuation should be a range. Giving a precise stock target gives everyone false precision. And thirdly, we need to take into consideration how far in the future our investments are going to play out. I'm wearing my hoodie because I'm going to go back to school and talk about some valuation techniques that I learned in graduate school as well as on the job as an analyst investment banker. Don't worry, this video is not going to be heavy on accounting. The best known valuation methodology is known as the DCF, the discounted cash flow method. The theory says that the price of a stock is the present value of its expected future cash flows. What that means is that if you are able to predict the future perfectly, you can lay out how much free cash flow a company is going to earn all the way out into the future, add them back, and that will give you what the total company is worth. Free cash flow is the profit that accrues to the owner of the equity of a business after you have taken consideration spending for capital expenditures. If it's not available, the next metric you want to use is net income. The E in the PE ratio is usually the net income. The net income takes into consideration the after-tax profitability of a company, but excludes any future capital expenditures. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is commonly used when comparing companies across different industries because EBITDA ignores different changes in the company's balance sheet. In the Fubo TV example, you can use back-of-the-envelope math to figure out what are other investors saying about a stock. Yesterday, the stock price was about $3.25. That gives us a market cap, a total equity value of about $3.7 billion. Fubo has a net cash position of about $49 million. Taking that away gives you a total enterprise value of about $3.65 billion. Let's start with 2026. The market is currently valuing Fubo at 10.4 times 2026 expected EBITDA. And in 2028, the market is giving Fubo a 6.3 multiplier today. The reason why the EBITDA multiple is going down in the future is because, consistent with a discounted cash flow formula, the market gives a premium for certainty. The market is going to give you a higher multiple the closer it is to the present. Next, you have to assemble a list of comparables, comps. You want to pick comps that are in a similar industry to your company and, if possible, have similar profitability. I went on the website Ticker, but you could go on Yahoo Finance or whatever financial news source of your choice and look up what the analyst estimates are for 2026 through 2028. I can see what range of multiples are investors paying for each of these four stocks. Disney shows that investors are paying 10.5 times 2026 EBITDA. Now, Google, on the other hand, is a company that is expected to grow earnings in the future. The market is paying 10 times 2026 EBITDA for Google, but only 7.8 times 2028. Investors are giving a discount in the future. Now, here's the fun part. If you want to make a valuation range of what you think your stock could be worth in the future, here's how you do it. You can see that in 2026, a 10.5 multiple on Fubo will give you a stock price of about $3.27. In 2028, the stock should be worth about $5.35. No one methodology is foolproof. Why don't you try breaking down the multiples and doing a multiple comparison? And then forecast in the future. What do you think the stock could be worth 2 years from now or 3 years from now? As always, thank you for listening. Don't forget to subscribe to the channel and check out my curated playlist. I'm going to add this video to a new playlist I'm starting where I talk about tools that I have used to beat the market over the last decade. Thank you again.